boy, man, Coop the Chemist, man, back here with another banger. You know what I'm saying? You're going to want to take notes on this one. And if you don't listen to any other video, this the one you need to listen to, man. I'm going to be going over risk management. I'm going to cut straight to the chase. It's going to be real simple. Ain't going to take too much of your time, but you definitely going to want to notate stuff on this because, like I said, this is where a lot of traders go wrong, especially beginner traders, because they don't have risk management. They don't know risk management. You have to think of yourself as a capital manager because that's what you're doing. You invest in your capital in these markets. Think of yourself as a capital manager, a hedge fund investor, something like that, because you know what I'm saying, you got to manage your account. You got to manage your risk. You got to keep it compounded. You want to be successful. So think like an investor, baby. So without further ado, I'm going to go straight to the notes. You feel me? I'm ready for y'all today. So main thing you know about risk management, I know this look like a lot, but two things. A, risk to reward, and B, how to calculate your lot size, right? Main two things you need to know. So I'll break it down real quick. Risk to reward, you always want a 1 to 2 or better. Like, damn, cool, what the hell that means? So you want the take profit of your trade to be twice the amount of the stop loss. Make sense? So just to show you, anybody don't know what to take profit, let's just say, I'll give y'all actually I'll give y'all an example in a few actually, but let's say I TP right here, or I enter right here. This would be my stop loss, right? 94 pips. This would be my take profit, right? 227 pips. This would be my risk to reward. It's a 1 to 2 4. So it is, this right here is 2.4 times. My profit is 2.4 times the amount I would risk. Make sense? Let's delete that. I'll show y'all a live example too. Let me just go over these notes. So why do you want a 1 to 2 or better? Because even if your win rate is 50%, you will still profit. Like, damn, cool, what's a win rate? So it's basically like a record, man. So I got these examples drawn up. These are hypothetical examples, basically to illustrate to you why risk to reward is so important. Because even if your win rate, even if your record is 50-50, you place on all these examples. I got them placing at 20 trades, right? 10 losses, 10 wins, a 50% win rate. But you will see the difference between a 1 to 2 if somebody's trading a 1 to 2 every time, a 1 to 3 every time, or a 1 to 1 risk to reward, because your risk to reward makes up for your win rate. Of course, you want to win more than you lose, but with a positive risk to reward, you set yourself up to win regardless. In these examples, you're finna see. So, like I said, hypothetical examples. You got 20 trades. All these examples got the same amount of losses, same amount of wins, but their risk to rewards are different. Let's go on this first one, risk to reward 1 to 2 example, right? So 10 wins, you make $100 every win. So times that by 10, that's $1,000 plus on your account, right? But the 10 losses you made, you lost $50. So for every loss times $50, that's negative 500 on your account. Hence, you still come out on top 500, even though you got a 50% win rate. You know what I'm saying? Your record 50-50, but because you trading 1 to 2, you still came out on top 500. We go to a 1 to 3, it's even better. You got 10 wins for $100, same amount. But only difference is you trading 1 to 3. So every time you lose, it's only 1/3 of what you're trying to profit, right? So you make 1,000, your losses equate to 330. Take that away, you still on top 670. In the 1 to 1 example, this is why I told you 1 to 2 or better. You want to trade 1 to 2 or better. Why? Because if you trading 1 to 1 and you only win, your record is 50-50, right? You're not letting your risk to reward really make up for that. So you want to stay away from 1 to 1s, period. After 20 trades, not profiting anything. Yeah, how does that sound? Whack, ain't it? So that's basically what you need to know about risk to reward. Always go for a 1 to 2 or better. If you don't write nothing else down on this notepad or these notes or whatever, you know what I'm saying, this is what you want to write down. Is this formula right here on how to calculate your lot size. This is going to tell you how many basically it's going to tell your lot size, what's your position going to be in the trade. And it's a simple formula, right? So you're going to go with your account risk divided by your trade risk, and that's going to give you your pip value. And then you convert that to your lot size. That's an easy step too. So I kind of like in this simple form, I just say, tell myself account divided by chart is going to equal my pip value. So in this example 1, you have to figure out your trade risk. That's pretty easy. You throw the trade on the chart, and it tell you how much you're risking once you put your stop loss. That's why I like TradingView so much. So same example over here, I would have bought in right here. My trade risk would be basically 109. I can lower the risk if I put it up 89, but basically that's your trade risk right there. How many pips you willing to lose on that trade. That's why I got it as chart on the notes. Account divided by chart, right? And you want to know that chart number, aka the trade risk. So 1, figure out that trade risk, right? And 2, figure out your account risk. and that's pretty simple too. So it all depends on how much you're risking out of your total account size. So typically I recommend 2 to 5% of your total account. That's how much you need to be risking, because I mean, you want to give yourself a chance. You know what I'm saying? You don't want to blow the account. Like I said, I'm a little more advanced. I typically go in like the 5 to 7% range, sometimes even 10% when I'm a little bit more riskier. But I would shy away from that, especially if you're just starting out, because think about it like this: at 10%, let's say you got $1,000 account. At 10%, that's $100. You risking $100 per trade. You basically giving yourself 10 shots before you blow that account. Or if you got some wins in there, maybe a little more. But at 10 losses, you done lost that $1,000. You know what I'm saying? So you want to go with 2 to 5%, giving yourself at least 20 shots to make some money. So basically, I got it as an account. To kind of to match up with this formula, it's basically gonna be the total account size time whatever percentage you risking. Like I said, let's just go with 5%. I got another example down here for you. For a $1,000 account size that's risking 5% per trade, right? He has a trade that he want to place. He or she has a trade that they want to place with the 30 pip stop loss. You know your account risk, right? 5%. Figure out the number. 1,000 times 5% is $50. That's your risk per trade is $50. Your trade risk is basically whatever the trade gonna say, how much you risking per trade. In this case, 30 pips. So and plug into the formula. It's that simple. Account divided by chart. That'll give you your pip value. So 50 divided by 30, it equates to $1.66 per pip. That is not what you need to enter in MetaTrader. You then have to convert that to your lot size, which if you watched my last video, you would already know. A 0.16 equals $1.60 per pip, or you can round up to a 1 point or a 0.17. Just know if you do take that L, it'll be just a little over $50. If you round down, it'll be a little under $60 or $50. I'm sorry. So let's go to the charts. I'll show you a live example. So right here, man, this is my markup on GU. You can see I got it, you know what I'm saying, traveling in this channel. For those who don't know what a channel is, that's basically what a channel is, top and bottom, when you see price moving inside of it. Kind of broke this channel over here, hit this major level, came back down into the channel, showed some love to this old resistance, new support, or the same bull trend line at the bottom. And I got this little, I would say, a channel inside the channel, which I like to do. So let's just say, let's say I go back in time. Say I go back in time to like right there, right? I would see, this is the daily, right? This is the daily. So it came down, it kind of made a bull right here as if it wanted to turn around. So then I would be looking for a buy down here to ride it in this channel. You know what I'm saying? This is prime time swing trading, right? Me personally, I would dive into the 4 hour because I see it is a bear trend. So, I mean, you see the bears, you see these lower highs down here. You know how I trade. Trend line on the first 2 highs, and I drag that bad baby all the way down. I know it did dip above it a little bit, but y'all know I like to put mine on the first 2 highs. If you want to, you can always clone this thing and put you another one right on the top to cover, so just so you don't get no escape out. But either way, you see the trend line, and I'm thinking bull, right? I'm thinking buy on the daily. You seen that, but I'm diving into the 4 hour, into the hour, to the 2 hour. For an entry, for a better price entry, and that's how I enter. I enter on a smaller time frame. So let's wait for a cross trend line break. Let's see if we get one. Pretty sure we get one. We seen it go up. Once I see that cross trend, okay, there's the break. There's the break. See, a lot of people jump the gun. You know what I'm saying? They'll probably see it on a daily. They'll jump the gun. Me personally, I don't like doing that. I didn't learn my lesson. I need a retest. If I don't get a retest, I don't enter. It's just that simple. Plus, I got another bull trend line right here that they can show love to. So you need a discounted price. Remember, the better your entry is, the more money you're going to make. So let's see if we get that retest. Boom, we got the retest. Wait for confirmation. You could enter here. You already know how I do it. You know what I'm saying? I see the cross trend line break. So I'm already thinking bull. I'm looking at the first 2 lows, the first 2 higher lows right here. I'm throwing that baby all the way out. You feel me? And I'm playing off that third one. You already know how I'm rocking. So let's see if we get it. If we don't get it, hey, cool. There it is right here. You see it start the wick. I still need to see a bull doji. A bull candle. And it's safe to say you got it right there. So me personally, once I see it start to retrace down here, say I'm diving in on the hour. If you're trading off the 4 hour, you can wait a little longer, but it just depends. Once you see what's going on, that's when you want to dive in, right? Because that's when you're going to get the best entries and the best confirmation. So immediately I'm thinking bull. Let me throw my long position on here. Let's just say throw it on right there. I could put my stop loss right here for a tighter loss, or you know what I'm saying, down here to be safe because you got low, you got higher low. If it's really bull, it's not gonna undo these lows. If it is, take me out as soon as it do. So let's just say I go ahead and enter with a stop loss right below this last low on the very next candle, right, for a 32 pip stop loss. That is a good stop loss. Typically, I like my stop losses 30 to 40, sometimes even less. But all in all, as long as your target, as long as you're targeting 2 to 3 times, hence the risk to reward. You see this one is 1 to 5. You know what I'm saying? So I will go ahead and target. Let's go back to the 4 hour. I will go ahead and target. You can go this last high, but more than likely I'm gonna go ahead and target for a higher high. I'm a TP1 right here though at the old high, just in case it don't and it fails to make a higher high. So you can drag that out. Let's go ahead and play it out. Let's see what it do. Well, actually, no. Risk management. You're right. I ain't even tell you how much I'm putting on it. So I know. Let's just hypothetically. Let's do this one at 1,000. Let's say I got $1,000 account, right? I'm risking 5% per trade on that $1,000 account. So bring the calculator out. First, let's bring this out. So I know my stop loss. That's my trade risk, right? That's the chart. My account, I'm risking 5% at $1,000. Do the math. It's gonna be $50, but do the math for y'all. 1,000 times 0.05, right? 5%, $50 per trade. So that would be my account. Remember, I told you the formula is simple. Account divided by chart. That's gonna give you your lot size. So 50 divided by 32, right? 32 pips. So I want to put $1.56 on this trade, or $1.50. And you can round up. Sometimes I round up. Just know, if you do round up, if it do hit your stop loss, it might be a little bit over $50. You know what I'm saying? But all in all, $1.50. Let's just stay at $1.50. That will equate to a 0.15. You know what I'm saying? This formula right here will give you your pip value. Don't get it confused. Main thing I'm saying is don't get it confused with this is what's going on your lot size. You're not gonna put a 1.5 on it. That equals $15 per pip. What this will give you is how much money per pip you want to put on the trade. So that would equate to a 0.15. Make sense? You should know that if you watch my last video, or if you know anything about lots, you want to put a 0.15 on it, aka $1.50 per pip. And like I said, that would risk $50, and I will reward. I would do the math on the reward, but you would basically see it in your account once the trade hit TP. So you had a little drawdown down here, no worries. 1, 2, 3, 4. Didn't really hit TP in 4 candles. Let's see. There you go, right there. Boom, hit your first TP. So let's see how much money we made. So I targeted 212 pips, right? I had, how much I had on it? $1.50 on it. Let's say I put a 0.15 on it, right? That's 15 cents, but I just want to let y'all know that's what it's gonna be lot size wise. 0.15 at $1.50 per pip times 212. So I made $318 on that trade. You know what I'm saying? I risked $50, but I targeted $318. So my $1,000 account is now up to $1,318. You know what I'm saying? Or $1,300, round it whatever you want to say it. You know what I'm saying? So that's what you need to know about risk management. That is key, and that's how you compound at the same time. So now that you're working with a $1,300 account, you still risking 5%. So your new risk per trade is not gonna be $50 no more. Let's say you keep it at 5%. Now you can risk $65 per trade. You know what I'm saying? So, you know what I'm saying? You see another trade opportunity. Now you know, hey, my next trade opportunity, I can risk 65. And that'll make more money on your take profit because you can up your lot size. Make sense? Make sense? What I'm talking about, baby. So I'll just let this thing play out. I'll let this thing play out, see if we see another trade opportunity. Actually, I think I do. I think I see something I like. So we got this low. Remember I told you the steep ones get cracked. We can go right here. Probably hit a sell. But then again, that'll be a scalp sell. So let's just say I do hit a sell right here. A little scalp sell, right? 15 minute. Show y'all boys how we be scalping too. So you see the break of the steep trend line, right? And you see the retest. So let's just say I was to enter right there once I seen that. And I was looking in the 15 minute, I seen the breakaway down here and I seen the retest. Let's say I was to enter right there with the same $1,300 account, right, for small little pips on the scalp. So man, let's just say I enter right here. Let's just make it real. Just because I stopped it right here. Put my stop loss right above that, right? So that'll be my trade risk could be 26, right? I gotta make sure my risk to reward greater than 1 to 2. So I won't even place the trade unless I can profit more than that. You know what I'm saying? And it has to make sense on the chart. Don't just put a TP to make it make sense for you. Make it make sense on the chart. I will put it back down to somewhere down here, and it might not get hit. It might not. The main thing I'm trying to show y'all is your next trade, you're risking $65 per trade. So like I said, account divided by chart, or account risk divided by trade risk. You know your account risk is now 65, your trade risk is 26. So you would hit 65 divided by 26, and you would put $2.50 on this trade. That equates to a 0.25 lot size. So $2.50 on this trade. See what it do. See what it do. Deal with a little drawdown. Make sure you don't let your make sure you do let your trade hit the stop loss, because if you would have took your money off the table, you would have missed out on this money. See what I'm saying? So you got your stop loss there for a reason. This case, you really probably look like you never even would have got your target hit. Let's see though. You might have though. It's the 15-minute. Okay, boom, got hit. Got hit. See what happened? Not too greedy. Still got your TP hit. I think it got hit right there. Probably maybe an hour, 30 minutes later. I don't even know. Probably 2 hours later. But check it. I just made 57 pips on this trade. My risk was 1 to 2. I risked 26. Made 57. So 250 times 57, because I put a 0.25 on it, times 57 pips. Now I just made $142. You feel me? So now my account, add that from 1,300. Now my account's sitting at $1,400. You know what I'm saying? That's 2 wins in a row. Why is risk to reward so important? I might lose my next trade, but check this out. I'm only gonna lose 0.05. I'm only gonna lose 5%. I'm only gonna lose $72 of that. You know what I'm saying? I can lose two more trades if I want to. Of course, you don't want to lose, but lose and come with the game. And the main thing you want to do is learn from every loss. And trading is a skill. So the more, like I said, a lot of my new booties, you might lose more, but risk to reward gonna make up for it. And the more skillful you are at trading, the less you will lose, and the more you'll know, hey, this is a good trade. Let me go ahead and take this trade. Main thing I'm trying to tell you is that's how important risk to reward is, and that's how important knowing your risk management and maintaining your account. Like I said, you gotta treat it like you are a capital manager, because that's what you're doing. You managing in your capital, and you can't just sit there and play with it. If you want to sit there and gamble, you might as well hit the casino. I tell my partner that all the time, and it's true. You know what I'm saying? You can lose a lot of money doing this stuff, so you got to be smart, and you got to know risk management. All in all, man, I hope y'all gained a lot from the video. Like I said, if you don't write nothing down, this is what you want to write down. And just remember that formula, because you want to know how much you're putting on that. That's how you manage your risk. And you don't want to put too big of a size compared to your account and lose your account in 4, 5, maybe 6 trades. And yeah, it'll be tragic. You know what I'm saying? So, your boy Coop the Chemist, man. Can't even talk no more. But hey, we out here, man. I hope y'all enjoyed it. 1.